Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about United Airlines Holdings Inc. Annual Report. United Airlines Holdings Inc. offers a wide range of services to cater to various needs of its customers. At the core of its business is air transportation, providing flights to destinations across the United States, Canada, Atlantic, Pacific, and Latin America. The company operates both mainline and regional fleets to transport people and cargo. In addition to air transportation, United Airlines Holdings, Inc. provides several other services. These include ground handling, which involves managing airport operations such as baggage handling and aircraft maintenance. The company also offers flight academy training for pilots and maintenance personnel. Furthermore, it provides loyalty programs that reward frequent flyers with redemption options beyond travel. The company's services extend to commercial businesses, freight forwarders, logistics firms, and national postal services through its freight and mail transportation services. This includes transporting cargo and mail across various regions. United Airlines Holdings, Inc. also offers maintenance services for third-party aircraft, catering to the needs of other airlines and aviation companies. The stock price of United Airlines Holdings, Inc. has experienced a notable increase over the past year, exceeding 5.85%. This upward trend can be attributed to several key events and strong financial performances. In January 2026, United Airlines reached an all-time high stock price of $116.32 USD, driven by strong investor confidence, net income of $3.29 billion, and effective strategy in navigating market challenges. The company's positive technical indicators in February 2026 further contributed to the upward trend. The UAL stock price moved above its 50-day moving average on February 3, 2026, signaling a potential shift to an upward trend. Additionally, the momentum indicator turned positive on February 6, 2026, historically suggesting an 80% chance of continued upward movement. United Airlines' strong fourth quarter 2025 earnings and optimistic 2026 guidance also played a significant role in the stock price surge. The company reported adjusted earnings per share of $3.10, surpassing expectations, and projected record revenue for the full year 2026. This led to multiple analysts raising their price targets, contributing to an over 8% stock surge on January 21, 2026. Furthermore, United Airlines' credit rating was upgraded by Fitch Ratings in January 2026, citing improved market position and successful debt repayment efforts. The company's record third-quarter revenue forecast and best first-quarter performance in 5 years also contributed to the positive sentiment surrounding the stock. Overall, these events demonstrate a period of robust financial health, strategic growth, and positive market sentiment that has significantly contributed to United Airlines Holdings, Inc.'s stock price appreciation. United Airlines Holdings, Inc. market capitalization of $35 billion is significantly larger than the average industry peer of roughly $6 billion. This shows that United Airlines Holdings, Inc. holds a significant advantage in their industry. United Airlines Holdings, Inc. trades at a higher price-to-earnings ratio of 11 times and a higher price-to-book ratio of 2.31 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 80% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for United Airlines can be attributed to several key areas. Advanced ticket sales have shown a significant increase, with a rise from $7.6 billion in 2024 to $8.1 billion in 2025. Additionally, ancillary services such as baggage fees and premium seat fees have contributed to revenue growth. Domestic revenue has also seen an increase, rising from $34.1 billion in 2024 to $35 billion in 2025. Furthermore, United Airlines revenue from the Atlantic region has increased from $11.1 billion in 2024 to $11.6 billion in 2025, while Pacific revenue has risen from $6.5 billion in 2024 to $6.9 billion in 2025. Latin America revenue has also seen a slight increase, rising from $5.4 billion in 2024 to $5.5 billion in 2025. On the other hand, there are several drivers of revenue decline for United Airlines. Short-term investments have decreased from $5.7 billion in 2024 to $6.3 billion in 2025, which may impact profitability. Additionally, potential differences between billed and actual amounts with credit card transactions could lead to a decline in passenger revenue. Other key factors that may impact United Airlines revenue include fuel costs, labor contracts, and disputes such as the one with Rolls-Royce. However, these factors are expected to have an immaterial impact on guarantees and indemnifications. Net income and profit margins overview. The company's net income experienced fluctuations between 2022 and 2025. Despite some periods of decline, the overall trend showed an increase in net income by $531 million from 2022 to 2023, and a further increase by $204 million from 2023 to 2024. However, this growth was short-lived, as net income decreased by $104 million from 2024 to 2025. Profit margins also underwent changes during the period. The operating income margin decreased from 9% in 2024 to 8% in 2025, indicating a decline in profitability. On the other hand, the net income margin increased from 5.5% in 2024 to 5.7% in 2025. The reasons behind these changes are multifaceted. The decrease in net income and profit margins can be attributed to various factors, including incidents that negatively impacted business operations and financial condition, increased competition from low-cost carriers, and the growth of government-subsidized competitors. In contrast, the increase in net income was influenced by voluntary or involuntary groundings of aircraft, which affected financial results and operations. Overall, the company's net income and profit margins were subject to significant fluctuations between 2022 and 2025, driven by a combination of internal and external factors. The company's financial performance is a testament to its ability to generate positive operating cash flow. One of the most significant indicators of this is the substantial amount of operating cash flow it generated in 2025, which stood at a staggering $8.431 billion. This impressive figure not only highlights the company's strong operational efficiency, but also underscores its capacity to convert earnings into actual cash. Furthermore, the fact that net cash provided by operating activities consistently exceeded net cash used in investing activities over the 3-year period, from 2023 to 2025, is a clear indication of the company's ability to generate positive cash flow. The inclusion of operating lease cash flows also provides valuable insight into the company's financial performance. In 2025, the company generated $971 million in operating lease cash flows, which further contributes to its overall positive operating cash flow. Overall, these indicators suggest that the company is indeed generating positive operating cash flow, a key metric for assessing its financial health and stability. The company's debt level and interest expenses have undergone significant changes in recent years. Initially, the debt level increased significantly due to fixed obligations, page 27. However, subsequent reports show a mixed picture. On one hand, the debt level decreased by 18% from 2024 to 2025, page 61, and remained the same in 2025 as in 2024, $713 million, page 86. On the other hand, long-term debt increased significantly from $2.8 billion in 2027 to $3.6 billion in 2029, page 43, and variable rate debt carrying value at DEC 31, 2025 was up from the previous year, page 48. In terms of interest expenses, there is a clear trend of decrease. Interest expense decreased by $256 million, 15.7%, in 2025 compared to 2024, page 40, and interest expenses have decreased due to lower interest rates on some debt instruments, page 88. The original interest rate on term loan credit and guarantee agreement was reduced from 2% to 1.75%, while new senior notes due 2031 and 2029 had higher interest rates of 5.375% and 4.875% per annum, respectively, page 41. Overall, the company's debt level has been volatile, but interest expenses have consistently decreased in recent years. The performance of various regions and segments in the industry has been mixed. On a positive note, the Pacific region saw significant growth with a 7.5% increase in passenger revenue, an 11.3% rise in passengers, and a 9.4% boost in RPMs. The Atlantic region also performed well, with a 4.9% hike in passenger revenue, a 5.8% increase in passengers, and a 5.7% rise in RPMs. In addition to these regions, the partnerships between Air New Zealand and Air Canada have been successful, yielding revenue synergies and enhanced customer benefits. However, not all regions have fared as well. The Latin America region experienced a decline in passenger revenue, with a 1.4% drop, accompanied by a decrease in average fare per passenger and yield. Furthermore, the legacy distribution technology has been underperforming due to higher costs and limited functionality. Europe's performance is implied to be positive through its partnership with Lufthansa, but specific metrics are not provided. The air cargo and third-party business segments also lack specific performance data, leaving their performance unclear. Management's outlook on company strategy. The company's management has outlined several key strategies to drive growth and success. One major focus is on expanding its domestic route network to generate traffic across the entire United States, while also regularly reviewing fuel price exposure to ensure a competitive edge. In terms of human capital, the company aims to attract, develop, and retain skilled personnel through its United Next plan, which includes providing competitive compensation and benefits. This effort is designed to make the company an employer of choice in the aviation industry. The company also plans to continue investing in other airlines and aviation industry participants, although these investments are considered high risk and may not meet expectations. To mitigate this risk, management has implemented a disciplined approach to capital allocation, ensuring that cash generated from operations will be sufficient to satisfy liquidity needs for the next 12 months. In addition, the company is focused on achieving operational excellence through technology innovation, as well as providing excellent customer service as a key differentiator in the industry. Management's goal is to earn the highest rate of return on its pension plan assets while maintaining risk at acceptable levels. Overall, management's strategy is centered around driving growth, improving operational efficiency, and delivering exceptional customer experiences. By investing in people, technology, and strategic partnerships, the company aims to achieve best-in-class margin performance and become a leader in the aviation industry. The company has made several strategic acquisitions and divestitures as part of its business development activities. Acquisitions are a key component of the company's growth strategy, with investments in companies working on commercializing sustainable aviation fuel, SAF, production. The launch of United Airlines Ventures Sustainable Flight Fund in 2023 is another significant acquisition, providing an investment vehicle to support startups developing technologies focused on decarbonizing aviation. In addition to these investments, the company has also acquired used aircraft through purchase or lease agreements and has explored potential acquisitions from other sources. Furthermore, it has made significant investments in startups developing technologies in aerospace, next-generation air traffic control, and AI-driven travel innovation. On the divestiture side, the company has modified or terminated existing aircraft order commitments, which may result in material liabilities to counterparties. It has also divested assets and separated businesses that may continue to have financial exposure to the divested entities. These strategic moves aim to optimize the company's portfolio and position it for future growth. The company's recent financial activities have been notable for its share buyback program. According to official records, a significant portion of this effort has resulted in the acquisition of a substantial number of shares. Specifically, it is reported that the total number of shares repurchased stands at 284,598,000,000. This large-scale purchase of company shares indicates a deliberate strategy by the management to reduce the outstanding share count and potentially boost earnings per share for existing shareholders. The sheer magnitude of this buyback program underscores the company's commitment to returning value to its investors through non-dividend means. Supply chain disruption concerns loom large for airlines. The airline industry is facing significant supply chain disruption concerns, which could have far-reaching consequences. One major concern is the potential limited supply of sustainable aviation fuels, SAF, due to mandates and a constrained carbon offsets market. This scarcity could lead to higher fuel prices, further exacerbating the financial burden on airlines. Supply chain constraints are another pressing issue, with delays in aircraft deliveries, inflationary pressures, and voluntary or mandatory groundings of aircraft contributing to the problem. The industry's reliance on a limited number of suppliers also makes it vulnerable to disruptions caused by global supply chain issues and labor market constraints. The certification process for new aircraft is also being impacted, with delays affecting the 737 MAX 10 aircraft in particular. Additionally, concerns about emerging SAF certification or book-and claim restrictions, as well as practices that bypass airlines, are creating uncertainty around supplies. Aircraft maintenance costs are also on the rise due to higher volumes of engine overhauls and component part repairs. These increased expenses will likely be passed on to consumers, further straining an already fragile industry. Overall, the airline industry is facing a perfect storm of supply chain disruptions that threaten its very survival. That concludes the financial summary for United Airlines Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.